The latest inflation data out this week is giving investors an idea of what to expect at the Federal Reserve's final meeting of 2024. Consumer prices came in slightly higher last month, and wholesale prices are at the highest level since last February. Joining me now is Apollo Chief Economist Torsten Slok. Torsten, thanks so much for coming by. Good to see you again.
Thanks for having me.
So what does this new data mean for the Fed meeting next week and for all of 2025 for that matter?
Well, we have seen, of course, inflation come down after the pandemic. It peaked in the summer of 2022 at 9, and now inflation is back at around 3. The problem is that we're not quite back to the Fed's target of 2. So yes, 3 is good, but it's just not quite good enough. And the challenge is, looking into next year, that we may get some tailwinds coming to inflation from the new administration potentially. That could potentially therefore play a role for markets that the Fed is just not quite able to cut interest rates as much as they have previously talked about.
Those tailwinds for inflation would be from what policies?
Yeah, so Trump on the campaign trail has talked about a number of things, but the 3 things that probably are most important for investors are that he's talked about lower corporate taxes for domestic manufacturers to 15%. He's talked about introducing tariffs, 60% on China, 25% on Mexico and Canada, and maybe 10-20% on everyone else. And he's also talked about we might need to see also some restrictions on immigration. And it happens to be the case that all these 3 policies will probably put some at least modest upward pressure on inflation. So the bottom line problem is that the economy is already strong, and if we add some modest upside pressure to inflation, that will mean that the Fed will have to keep interest rates higher for longer, and it's going to be more difficult for the Fed to cut interest rates in 2025.
I want to give you credit because you have been saying literally for years that interest rates would have trouble getting from 3 to 2 and that the U.S. economy was stronger than most people thought. So your crystal ball has been clear so far. We'll see what happens. I want to ask about the investment implications here. But first, you have continued to be bullish on the U.S. economy and bullish looking forward, and yet some people feel so lousy about the economy. What makes you bullish? Why do others feel bad?
Well, I think a very important aspect of what's going on at the moment is that consumption on average is doing well. But that reflects some differences underneath the aggregate consumption numbers. We are seeing that, of course, stock prices have gone up, home prices have gone up. If you own fixed income, the cash flows you get in private credit, the cash flows you get from your fixed income investments at the moment are at the highest level almost in decades. So therefore, people who own assets, they have generally been doing quite well, whereas individuals who have debt have generally done less well because interest rates have gone up. And who is it that owns debt? Well, if you owe debt to someone, you're generally a younger household because when you're young, you owe money on your credit card more than other generations, on your auto loan, on your student loan, and therefore people who have more debt have been more vulnerable to the Fed raising rates. So there is some segmentation in who is it in the consumer space that's been doing well and who's been doing less well.
So what does this mean for the stock market next year?
Well, the challenge, of course, for the stock market is that when interest rates are higher for longer and we still have a good economy, that should mean that we should see growth. But the challenge is that the stock market is now so concentrated in the Magnificent Seven, and the valuations of the Magnificent Seven are very, very high. Normally, the PE ratio for the S&P 500 for the last 50 years has been around 16, 17. But you see that the PE ratio for the top 10 companies in the S&P 500 on a trailing basis is at the moment 49.
Wow.
That means that a lot of these companies that are big, namely Magnificent Seven especially, are very expensive. So that makes it difficult for investors to put more money into the S&P 500, especially when those stocks that have been driving returns continue to be at very high PE ratios.
We're short on time. You like mid caps because they're big enough to not have too much debt, but a little bit smaller than those Mag 7?
That's why if you have to be in public equities, I do think that you have the high and more expensive stocks and the big stocks, they are very, very overvalued. And the small cap stocks are vulnerable to interest rates staying higher for longer. In the Russell 2000, 40% of companies have no earnings. So that means that if you have to be in public equities, I think the mid-cap companies are generally looking better.
And you keep saying public equities. I'm hearing a lot about private markets. Fewer companies are going public, of course. So you are a fan, and of course, Apollo's big in the private markets business. Why do you like it?
Well, what's particularly interesting, of course, in private markets at the moment is that if interest rates are higher for longer, you can go up in quality in investment grade, first lien, senior secured, top of the capital structure. And if yield levels are higher and the spread on top of yield levels are still at least a higher elevated levels relative to where they've been historically. That also tells you that you can get nice cash flows in fixed income, in particular in private credit at the moment, benefiting from the level of yields being higher in safer assets such as investment grade credit.
Alrighty, we're going to have to leave it there, but Torsten Slok, thanks so much. See you soon, I hope.
Thank you, Jack.